welcome to Global Mantra Outlook 2013, a special show that profiles prominent fund managers from the City of London and gets their views on the global market environment. Joining me on the show today is Mark Artherton, who's the Director of Emerging Market Equities at Allianz Global Investors, and he joins me right here. Mark, thanks very much for taking out the time.
My pleasure.
Let's try and understand the risks that you're foreseeing for 2013, given that despite all the worries coming in from the Eurozone, 2012 was rather rewarding in terms of returns for emerging market equities. Do you think we can build on those gains, or will it be volatile?
I think if we're looking out into 2013, that the first half of the year is likely to remain pretty volatile. A number of the risks that are in the markets at the moment are likely to remain. A number should be resolved over the next few months as well. And so that gives us a sort of a cautious outlook for the first half. Now, depending on how these risks resolve themselves over time, we remain pretty confident that the second half could see some positive returns in emerging markets as a whole. The valuations are relatively low on emerging markets. However, we don't think there's any real need for a big multiple expansion or likelihood of a big multiple expansion. But the earnings growth expectations, yes, they have come back down, but I think we could be fairly confident that you get a high single-digit to low-digit earnings growth across the board once we've had some further expectation ratcheting down. And that kind of return, I think, is a possibility for 2013.
What about Western world worries, especially, Eurozone concerns as well as what happens to the fiscal cliff? How are you accommodating these risks in your base case scenario?
Just running through the risks, I mean, it's a very risky world out there. I mean, we have the fiscal cliff issue, as you mentioned, which, going December, January should be resolved in whichever way because of the way the politics is going to work. At the moment, it appears unlikely that a great compromise will occur, but I think we're still working with a base case scenario that it's unlikely that you'll get the full impact of the increase in taxes there. Secondarily to that, you have the newly awakened issue in the Middle East with Israel and Hamas, and that remains an issue. And there's always the overhang of Israel and Iran, which is a bit of an issue for us. And we don't see any near-term resolution of that. That's just going to be an issue that's going to be with us for a while. On the Eurozone front, the kind of resolution that's required there is not a quick fix. It's a long-term resolution. You have as well, I mean, this list is quite long. You have also the political transition in China, and we remain quite constructive about what Chinese policymakers are going to do. And also on China, one of the big plus points we've got now is we are starting to see an increase in growth already in China. And so we do see a cyclical increase in growth for China.
Do you think that the earnings slowdown has hit its bottom in emerging markets?
I think there's probably a few more downgrades for earnings to come. I mean, just on a seasonal basis, it tends to work that most analysts will downgrade their earnings in August. And we've seen that in emerging markets, and we've seen significant downgrades. However, there's still, if you're working through the system, we still think there's certain more downgrades to come for GDP growth in emerging markets, and that'll filter straight through to the earnings growth because the analysts have to adjust their expectations to what their macroeconomists are telling them. So we think there is a slight downgrade, and again, that adds to the volatility perspective in the first half, we think. Now, we are actually entering a seasonally strong period generally for emerging markets, and so again, I think that supports the underlying trend being up, but relatively volatile.
Do you think that investors will be willing to take more risk, that money will flow into riskier assets in the year from especially the fixed income side of the business?
I think our viewpoint remains the same. I think with these risks in the market, your average investor, your average asset allocation committee is going to remain very cautious. And so I think they're going to remain invested in fixed income assets. Also, the regulatory change that have occurred over the past few years as well tend to favor investment in fixed income assets over equities. And so I think we continue to see the trend that we've seen in equity markets, which is this general deallocation from developed equity markets. The US may be being an exception to this, but flattening out. but emerging markets capturing whatever flow there is into equity markets. So, for example, this year, even though it's been quite volatile, we've had a net inflow in emerging market equities of $26 billion, which is quite positive, and that compares to 2011, where we saw a net outflow of $46 billion. But we are probably the only, near enough the only major equity asset class that's seen these inflows this year.
But do you think overall the outlook on BRICS within the EM pack is still as strong as it was the last couple of years?
BRIC itself has actually underperformed over the last couple of years. And I think there's a general negativity around the BRIC concept at the moment, which, from a contrarian point of view, you can actually see as an opportunity there. I think there has been some bursting of the overt bullishness, how the market had got too bullish about things. However, the underlying trends still remain in those economies, and you can put in place a kind of a theory about how these things work, in that you go through periods where you have markets, companies that are flavor of the month. And then that means that management and politicians start to believe that they can walk on water, as it were. And so they don't undertake the continuing reforms that you need. And so they stop and they try, I mean, to a certain extent you want to use some of the benefits in the country, and I can understand that completely, but you need to get the balance right. Now what we've been through over the last 2 years, and an absence of capital inflows to these markets, and an underperformance of capital markets, you're getting a reimposition of some momentum towards positive news flow. And India is a prime example of that. The reforms are back on the agenda. And I think it's precisely because the markets have that discipline now, and will impose that upon markets. And we think that's a positive.
Let's talk about India and China. The criticism that China is facing right now is that the new leadership, people are from very influential families, they come from a very powerful background, and that they may not be able to really deliver in terms of clearing out the imbalances that are there in the economy. Do you share that view?
I think if we look at the makeup of the standing committee now, the 7 members, there has been some disappointment. Some of the key names associated with reform are not there. And we're getting this natural feedback that it just means a continuation of what was there. I think it's very, very clear what's happened over the last 12 months in China shows that is not the case. And we're waiting to see what they actually say, rather than looking too deeply at the perception of the type of character that the new leaderships are. We think there's a great understanding that the Chinese economic model does need to alter. Also, at the same time, there are large challenges within that economy, which you've got to bear in mind that China is now a middle-income economy. And lots of middle-income economies face these similar challenges. The Chinese are in a slightly enviable position in that they have this centralized structure, so therefore they can process decisions relatively quickly against a more democratic country like India, for example, which appears to be slower. But it also leads to problems of its own. So we're not calling one system better than the other. It's just certain aspects can go more quickly.
Does that get reflected in the market performance as well, which has not been very impressive for the last 3 years?
No, the Chinese A-share market is still in the doldrums as a whole. If you look at the valuation levels, they're relatively attractive at this point in time. However, to see a takeoff in that market, it's a domestic confidence issue, because there aren't that many internationals who are involved in that market. It's very much the domestic feel for what goes on. Now, if you're a domestic investor, and as everybody is looking globally, you're looking for investment returns which show low volatility, which give you a positive return, you're still avoiding the equity market, because the history of the equity market shows booms and busts in China. Whereas the property market, on the other hand, despite the caps, despite the controls, the property market still delivers you that positive return year in, year out. And so it's very clear why you can see that your average Chinese investor is very much, I want to be in property. Or to a certain extent, notwithstanding the last quarter's numbers, want to be in gold. for example. So to draw them back and get them back into the equity market, you need to see that stability.
How do you contrast the India story then?
Now, the short-term dynamics for the Indian economy still remain relatively negative. So, for example, September's industrial production was a negative number, where there was an expectation of a positive number. The trade balance has hit an all-time record high in deficit terms. These are not good signs, and there's a potential that you know, the ratings agencies again are looking at India's position.
How much of that would hit sentiment if that were to come by, a downgrade from the rating agencies?
We're very clearly watching closely what the ratings agencies are saying, and there is a growing feeling that there could be an issue with the rating. Now, it doesn't help that, for example, the Spectrum auction we've just seen appears to have been pretty disappointing. I mean, against the expectations, it only appears to have drawn in a quarter. Now, that was going to be a potential boost to the fiscal side of things, and the ratings agencies are looking at things like that. And so, therefore, if that continues through, the economy is going to be slow, which is always a bad thing for tax revenues. So, yes, it's very definitely something we're keeping a very close eye on.
So, between political risk and macro risks in India, which is top of the mind for you as we step into 2013? Because we're also looking at elections down in 2014.
Yeah, I think 2014 is still just about far enough away that the macro risks dominate. However, the political risks will start to come back towards the end of the year. If we're looking at the Indian market itself and making allocations to the Indian market, I think it's a very difficult position to be hugely bullish about the Indian market at this point in time in relation to other emerging markets. However, we still think...
Even though the market has actually outperformed other markets this year? Yeah,
it has. I mean, without that reform announcement, though, it was very clearly underperforming for quite a long time for this year. Now that reform bounce has started to peter out, we think it's likely to remain the same on the aggregate level on the market.
Do you think that funds have moved in a meaningful manner from underweight to neutral on India, and you think that stance could only strengthen perhaps in the new year?
I think that there was a certain amount of movement around that reform announcements and the set of reform announcements. There were a number of market investors very clearly who were underweight and wanted to close that, notwithstanding a certain participants who were shorting the market, and so they just closed those shorts up. However, looking out, can we identify any clear drivers that leads India to be a strong, a long-term outperformer of emerging markets? We think that's quite difficult at this point in time. The economic news flow has dominated that more recently, and I think the reality is reforms are long-term. What's going on in the economy today is obviously today, and the markets are still very much obsessing about what's going on in the near term. What it does put a cap on is it does put a cap on the downside to your market. If you look at the valuation on the Indian market now, it trades at around about 10% discount to where it's traded post the GFC. And so definitely there's a pricing in of that weaker economic performance. Could it go to a 25% discount? Yes. I mean, markets can pretty much go where they like. And so it's very hard to sit here and say it's priced, but looking at that valuation, it suggests...
Mark, let's talk about the investment opportunity in India. Where is it that you are spotting value?
Okay. Value is an interesting concept at the moment in these markets. Things with high PEs tend to be doing relatively well, and things with low PEs tend to be doing relatively poorly.
And there's a premium that's been given to growth, essentially. So how do you draw that balance between value and growth?
There's definitely been a premium given to stable growth. And so consumer staples companies, for example, trade at even higher premiums than they used to. We think that's understandable because there's so much risk around the more cyclical names and the earnings of the cyclical names that what looks like a low PE could very quickly turn into quite a high PE if the stock price stayed where it was and the earnings continue to be downgraded. So that kind of risk is what investors are trying to avoid at the moment. And also, if you look at the earnings trends, so for example, the third quarter earnings that have come out recently in India, The sectors that have beat their expectations have been these more stable, so the consumer staple sectors, the healthcare sectors, and the ones that have not met those expectations have tended to be the more cyclical sectors. And we think that's the likelihood of that is that will continue going into the new year. Now, once we see, especially in China, even a sort of a subdued reacceleration in earnings growth, that could then stop your cyclical earnings downgrades for a certain amount of time, and that might generate some more interest in those types of companies. And our view on this, just globally at least, on the cyclical side, is we're looking for best-of-breed cyclical companies.
So when you're looking at India, is your focus essentially with the defensives?
Yeah, I think we've liked, for example, ITC for quite a while. We continue to like the story at ITC. We think that the long-term trends for consumer staples in growing young countries like India remain very, very strong. Now, with the current multiples that these stocks are on, it's very difficult to see outsized returns from these stocks, but we think as a core part of your portfolio in the long term, these are stabilizing factors in your portfolio, and investors should be overweight. I mean, historically, it has been shown that increasing your weight to the lower volatility stocks in the long term adds value to your portfolio. So we remain positive in that. In the industrial space, we have got a position in Larsen & Toubro, L&T, which I suppose could be seen as being on the more risky end of the spectrum. And really that's it. We run a fairly concentrated set of positions in India.
What about the private banking space in India? Holdings in HDFC Bank, ICICI Bank, is the call really to be with the leaders? And if so, then what about the leaders from the PSU banking lot, the likes of an SBI?
I think we're much more comfortable, again, as a general framework, of being in companies that are run by private management to the benefit of shareholders, and that tends to be the case in the private banks in India. We think on an aggregate basis, the banking market in India is a very attractive long-term market. And the setup and the structures of that banking market are very, very positive. We're slightly concerned that the economic slowdown could lead to an increase in NPLs, and so that tempers our optimism currently. However, on a medium-term basis, we still expect to be very invested in the financial services market. But as I say, very much with that exposure to the private against the state.
At any point in time, do you think that there would be an opportunity in PSU banks, purely from a value perspective?
Definitely the headline valuations are lower, but they have been lower for a long time, and we don't see any near-term reason why that valuation differential should reduce, and we're not looking actively at investing in the state banks at this point in time from an emerging market perspective.
I see in a lot of foreign portfolios Infosys still being a core holding, despite the number of downgrades that have come in and despite the earnings concerns that have been expressed by investors. Why is that the case? Because now you're seeing a bit of a divide in the IT space, with HCL Tech and TCS clearly showing better earnings and better performance price-wise.
Yeah, I mean, I think this concept of core holdings, I mean, Infosys, large index weight, which kind of helps. I mean, it depends on how you manage your portfolio. I mean, if you're managing your portfolio and you cannot take the risk of not holding Infosys, then that might be the reason why it appears in some people's portfolios. However, is it seen as a global emerging markets core holding anymore? Not by us. We don't think Infosys would be is considered in that sphere anymore.
Among cyclicals, do autos interest you in India?
Bajaj Auto, for example, has performed very, very well. We've looked at it on occasion, but we think there are sort of issues domestically within the market. And then if you look at a company like Tata Motors, where the vast bulk are coming from JLR, Jaguar Land Rover, which has been very, very positive. But we're coming from this angle, we're trying to find long-term, so 5-year investment ideas. And the Indian autos, for us at the moment, in terms of the level of competition, where India is in terms of its development, doesn't look that attractive to us as a whole.
From the consumption side, were you enthused by the United Spirits Diageo deal?
We think it's a two-way thing. I mean, there's a lot that developed market companies can learn from these kind of acquisitions and the interaction with Indian companies.
Mark, the last time we spoke, you were underweight on Reliance Industries. Has that stance changed?
Yeah, that remains the case. In our global emerging markets portfolio, we still do not hold Reliance. There's a number of reasons for that, and we're actually quite glad we didn't hold it for a number of years. You know, delays on the gas side of things, you can expect. I mean, globally, people who are involved in E&P, you see the delays. More our concerns are actually just a global concern, which is around the refining side, around that side of the business. And we just think that today, to be involved with that kind of business on a global basis is not the place that we want to put our money, because we think that the shale gas issue in the US is fundamentally altering both the petrochemicals and the refining industry across the globe.
Reliance is building assets there.
Yes, they are. It's positive to see that happening, but the vast bulk of the business is still based in India, and we are selectively have some exposure to this in Asia, but in terms of ranking, we don't see Reliance as being one of the better ranking companies for us to hold. Final
word then, Mark, as you step into 2013, do you feel more optimistic about India as a story?
Yes, we do. I mean, I think if I was sitting here in August, I think I'd be quite depressed about India. It looked like there was no reforms. It looked like the economy was going in the wrong direction. It looks like it was going to be downgrades galore. Then you had the reform turnaround in September, and we're very, very positive that that occurred and that the politicians saw that fact. However, we still see bumps in the road for India in the near term. But it's not just India that's got these bumps in the road. Globally, we see bumps in the road. But I think India's still within that space where we can see, notwithstanding the elections in 2014 causes maybe a little bit of concern for the second half of 2013, where we expect to be positive emerging markets. But if I then turn to the medium term, India, in terms of the demographics, in terms of the investment potential, in terms of the innovation that you see in India, in terms of the companies in India, we're very, very positive.
All right, we leave it at that. Thanks very much, Mark, for joining us and sparing us your time. With that, we come to the end of this edition of Global Mantra. Thanks very much for watching.
Indian companies and looked at the big picture, whether it's the auto sector, whether it's the consumer sector, and look at, for example, where United Spirits market cap relative to the opportunity and relative to their market share, and that's probably what Diageo was doing. They're willing to take a long-term view on India.